All right. Welcome to the SynMax Intelligence Podcast. Today we're going to be interviewing Jamie Hurd. Jamie Hurd is the Vice President of Capital Markets at Tourmaline, Canada's largest natural gas producer, with over $20 billion in market cap, where he leads mergers and acquisitions, capital allocation, and investor relations. Jamie is also one of the most followed voices in North American natural gas markets and is widely read by the natural gas trading community. That's how I heard about you. Jamie, welcome to the podcast.
Thanks very much for having me, Eric. It's been fun to get to know your product a little bit at SynMax and understand what you guys are doing. And I've listened to some of the back catalog, and I really enjoyed the first episode with Bill. That was incredible.
Yeah, it's hard to top that. Appreciate the shout out too. As we agreed, plugging some SynMax products along the way. So I want to start out talking about Tourmaline. Tourmaline, obviously one of the largest or the largest natural gas producer in Canada. But I understand that they behave differently than kind of the typical U.S. E&P that most of our listeners might be used to. What's different about them?
There's a couple of differences. Some of them are structural, some of them are legacy, some of them are how we operate. To name a few, we own and operate effectively all of our midstream. So we own the gas plants. It saves us, from our perspective, about 75 cents an MCF in cost structure. Our wells and our operations in aggregate would break even around $1.50 a GJ or $1.50 an MCF in Canadian dollar terms. That's about $1 American these days, given where currency's gone. And we could pin some of that on owning and operating the midstream. And the other part is the asset quality. That's also a difference. Canada is blessed with long life resource, and Mike Rose, CEO of Tourmaline, was early at snapping up as much of it as he could. And we did a big push through COVID and bought as much in BC as we could in the core of the Montney as we saw it, and now have 75 years of inventory, which would be about 50 years more than some of the longest inventory lives in the United States. Many firms are, if the good stuff, in the 5 to 10, maybe 15 year time frame. So it's a totally different perspective on what is resource life, what is asset value. We're growing our business. We're growing it when the market can take the volume, but growth at all has been taboo in upstream E&P for almost a decade now, really since 2014, the original OPEC price war. The industry retrenched into a state of discipline, a state of return, and trying to generate profits and return those profits back to shareholders. And growth was very taboo. Our business grew through acquisition, and when times were poor. When times were better, organic growth started to come and be a part of the story and continue to be a part of the story. We never didn't have organic growth, but that's definitely the focus over the next 5 years, is building our BC platform. And the investor landscape has scar tissue over how 2009 to 2013 spilled out. And there's definitely a sense that growth can be bad. And you'll listen to peer conference calls, and a peer might be a peer that doesn't have any growth. And the questions the analysts will ask will almost feel like they're daring them to say the word growth. And, we've stood differently, but we've grown, from our perspective, responsibly. When the markets are soft, whether it be weather or periods of oversupply, we have pulled capital back and taken growth back. But we are still advancing assets in British Columbia, building gas plants, and it makes Tourmaline better by becoming bigger in BC. Our cost structure lowers, our margins grow, we'll have more condensate and NGL growth. So we'll have an overall larger margin. And when you pull the aperture back and think about what we've probably been discussing as an industry, and even around the dinner table over the last 6 months, we think resource is going to have a great need in the next 5 years. We think we'll need a lot of gas for a variety of things domestically and internationally. And Canada is trying to refine itself and in its purpose and where it fits in the world. And being a provider of resource is going to be a big part of it, we think. And so we need to get ahead of that, because these things take time. It takes time to build up a resource and be able to offer it. And so we're trying to put our first step on getting it all ready and make profits and returns for investors along the way.
That's fascinating. I have a lot of follow-up questions. So the first one is, how do you think about the difference between energy independence and energy dominance, right? Like when I look south of the Canadian border to the US, we have absolutely achieved energy independence, and Canada has for a long time, right? And we've had a lot of benefits to this because, gas is cheaper here. That means that, a lot of resources are cheaper. And, this is turning into a huge boon, right, especially in the middle of the data center buildup. But that's changing with LNG buildout along the coast. And, Canada is not far behind, right, with their own LNG buildout ambitions. And what happens when, it isn't just always running at max LNG export capacity. When there's actually slack in the system, LNG becomes another balancing factor. And that means you are more exposed to global shocks, right? And America has largely, at least during the Iranian crisis on the gas side, right, not had to experience those shocks because, any analyst will look at it and say, okay, well, LNG is at max capacity. It's going to continue to be at max capacity, like it doesn't affect Henry Hub. So, as you're talking about kind of like looking into Canada's future, right, you already have energy independence, right? Is energy dominance always a positive thing? Is it an ambitious goal, or how do you think about that?
I think it's largely a positive for Canada. It's giving what you have to give and then finding ways that you can bring partnership into that equation. So what is Canada great at? Canada is great at bringing low-cost energy resources, low-cost basic materials, mining, precious, copper, coal, to market along with the agriculture and uranium piece. So, we can be the breadbasket, the energy basket for the world. And we tried to mimic, I think, the service economy that the US is great at for, 2 decades. And we had moments of brilliance. Everyone had a BlackBerry at some point. We've had some major successes in, Shopify, or in our financial sector. We have strong businesses, but it's not an area of natural dominance. And I think I like that you've used that word. Whereas between independence and dominance, independence might mean that, okay, I don't need others, but dominance can mean that I can actually do this better than everyone, right? It's kind of thinking about, where do you steer your child when they're going into their first job? Do something that you are incredibly good at and you're passionate at. Well, Canada can do that, and North America can do that. And so dominance and energy for me would be, okay, we can power our dominance of chips in AI data centers with low-cost energy that will stay low-cost for decades. This isn't going to be a temporary blip where gas is low now and then we surge through it and all of a sudden we're consuming as a nation $6 gas, not $2 gas. If we link this up correctly, plumb the Canadian resource depth into the North American energy fortress, we should be having low-cost energy for decades that could be a cornerstone on this new economy that we're basically just embarking onto. And then on the LNG side, I think that the Middle East has had an incredible cost structure advantage and has used that for energy dominance, but they have fragility in their ability to make sure their supply is always available. And we're seeing that in real time today. I think Canada enjoys the same benefit the America did in both world wars. Massive oceans on both sides. Security is easier to accomplish. And if we can get our supply chain set up correctly in moments when there's global peril from one supply source in an area of the world that isn't as blessed, we can be that supplier of need. And I guarantee that is going to show up in acquisitions, trade deals, supply deals in the next 24 months. I think everyone's very wise to that today. And so from an industry and an investment perspective, who has something valuable to offer that isn't apparent in the market, but is definitely apparent at the, board tables or strategy tables by governments and, conglomerates around the world that are trying to redo their algebra of how they're going to power their business for the next 20 years.
Yeah, I like the way you framed that. Obviously these kind of technology advantages tend to be not long-lived, right? I think, America with Silicon Valley and so much innovation, we've had this really long period of technological advantage over the rest of the world. But, you could say that energy is maybe further up the value stream, right? And perhaps an enabler of some of these things, right? And the closest relationship is definitely, okay, it's going to take a lot of energy to power this AI data center boom. That's an immediate advantage, right? Data centers are going to be built increasingly in North America, more so than they're built elsewhere around the world, just because the cost input is easier. But another thing you talked about was kind of, I think you were alluding to soft power advantages, right? When you are a gigantic trading partner and you're providing your value to the rest of the world, right? There are other less direct, hard to measure, right? Just advantages in the geopolitical sphere that, could then accrue benefits to Canada. And maybe that's the underpinning of other industries and more prosperity and wealth. So I like that. But my actual question, way off topic, you mentioned the Montney, which some people call the Permian of the North. Do you agree with that characterization? How is it different? What are the advantages, disadvantages compared to kind of the already completely owned and producing Permian?
Yeah, the Montney and the Permian. The Montney is huge. And the Permian is too, but the Permian had the egress advantage of being, within a state or two, New Mexico, and being right near one of the biggest trading hubs in the entire world, the Gulf Coast. And you guys are about to bring 4 Bs online of new gas pipeline. These pipelines have taken like 24 to 36 months to build. It's just incredible how fast you can plumb into your basin with new egress. And that advantage also means that it's a sugar rush. It's a sweet that will be enjoyed voraciously for a shorter period of time. The Montney is taking time to get after. There's assets that we've acquired over the last 5 years that we're still putting the first road into, like, never mind pipeline. We're still mowing down new trees that, haven't really had any industrial development in the area ever. But it's 645 TCF of gas, and we're 35 TCF through. It's like not even 10% done. And the economics are incredible. And so when we measure the Montney relative to gas basins across North America, especially the ones that have been able to be actively developed quickly, we see cost structure changes happening real time, where the Haynesville or even in Appalachia, you'll see tangible evidence that it's taking this basin a higher cost to turn a profit every year. And it's because the wells have become a little bit less productive because the best wells are drilled behind them. Whereas the Montney is actually still in the learning phase. It's actually still getting better. Tourmaline's getting better, but widen the aperture, the industry is getting better. If you measure the industry as a whole, it's drilling better wells last year than it drilled any of the last 3 years. And so its cost structure is still coming down. And that gives it room to compete. And this is where it gets into the great kind of nodal math of, well, what is it justified to build a pipeline? Or how do I think about the economics between one area and the next? And how do I think about these really 30, 40-year bets infrastructure companies have to make and shippers have to underpin with long-term agreements? If the Montney's cost structure, as I was saying earlier, is, in Tourmaline's hands, roughly $1 an MCF US or $1, and the Haynesville moves 350, 450, and Permian is doing the best it can to grow at 2 Bs a year, and that kind of peaks out at 2030, and then it starts to level off, also with its own cost structure, more crude-borne. You could line of sight a lot of infrastructure between the two basins. If you can build pipe between the Montney and the Gulf Coast, all of a sudden there's a larger and larger economic rent between the two. The other area that I think the Montney's been interesting to push through is it is a true resource play. And there's been many plays in the U.S. that have tried their hand at being large-scale plays. The PRB's tried, TMS has tried, but they end up being poorly or good in one bench and not the other, or more constrained. And the Permian's proven itself to be incredibly pervasive. Wolfcamp A works in so many different townships, and up and down the stack seem to have good predictability in what's going to work, and learnings in one part of the play translate well to learnings in another part of the play. That's the Montney too. The Montney A, B, C, or however, upper, middle, lower, however each firm is enabling it, seems to translate learnings incredibly well. And I think that's going to be a really important part of the next 10 years. The last 10, 20 years of the Montney was figuring out the aerial extent of where it is and what a good Montney well looks like and how the liquids windows change from dry to liquids rich. And now we're kind of getting into manufacturing mode. We've got the big pipelines started. The LNG plant, our first one, is up. And now it's how do we truly manufacture in this play? And we'll take learnings from the Permian and then we'll apply them in the Montney. And I think a learning in one part of the Montney will very well translate elsewhere.
That's interesting. I never thought about like kind of the homogeneity of the play being an asset, but it enables it to be, a safer investment, attract more capital, kind of turn into a manufacturing business as you decide to, explore it and continue to produce out of it. What do you think of Shell's acquisition of ARC Resources? And does that kind of reveal a little bit more of maybe, what the strategy is and where the Montney is going to be going in the medium to long term?
It's an incredible deal. ARC has been around for 3 decades. It's for anyone who's cared or thought about energy in Canada, ARC has been a household name for a long time. It's a big employer in the city. It's a little shocking to see it go in some regards. Shell bought Mike's last company, Duvernay. I joined Mike in this iteration of his career. So at Tourmaline, I joined in 2019. But many people at Tourmaline were at Duvernay and remember that time. And so it's a moment, a bit of reflection at Tourmaline of, okay, Shell's back in. And why? And what does it mean? I think it's a really good study of corporate strategy just to read or listen to the last 3 calls Shell's done. And the call before the deal, Shell discussed at length with analysts how they were going to fix their reserve life problem that analysts were looking at reserve lives getting shorter as they, each successive reserve report was coming out and went from, and I'm going to, misremember the numbers, but something like 9 years to 8 years to 7 years. It's getting the horizons coming in on how these reserves are booked. And analysts were trying to ask, what's your strategy here? In 2032, this business can't be a blowdown business. And Whale said, we have a solution in 2030. We will come with a solution.
Wait and see.
And he solved it in Canada. And he positioned the deal as an oil deal, which I thought was interesting and astute. This is a WTI linked condensate barrel, trades at a premium, and there's legs there, and there is. This also totally ticks the box on all the gas he needs for his LNG Canada allotment, both phase 1 and phase 2, and now have gas, and reintroduces Shell to upstream development in Canada in a big way. They were there in Groundworks and they were there in Gold Creek, but it was modest. And this is now a real presence. And in a way, he bought the Permian deal they missed in the last 5 years. And I think Ovintiv is doing the same push. And I actually think history will look back at these deals like that the Permian elevated to a point where you're buying resource at, the locations that are undrilled are being valued at $8 or $9 million a location is the implication for how much money you're paying for some of these deals. In the Montney, you're able to acquire locations for $1-2 million. And that's up from where it was 5 years ago. Tourmaline was buying Montney at sometimes $0 or a couple $100,000 per location. Now it's in the $1 to $2 million range, but still a vast discount from the American resource. And if Shell can show the world, and Ovintiv can show the world, and Tourmaline can, that you can plumb this resource in, it's not hostage, it's not stranded, you can get to a market, the oil barrels clearly can, and the gas barrels can as well, then you've come in and bought a great asset at a discount.
Yeah. This makes me think back to when SynMax first started tracking Canadian rigs and frac crews. And we're talking about the Permian versus the Montney. We thought we had a data problem because it was like, I think about this time of year, we noticed there was a gigantic drop off in frac crews. And oh my gosh, something wrong with our imagery ingest, something wrong with our object detector and classification, and so on and so forth, right? And then we talked to somebody who knew the Canadian market, and they're like, oh, that's slush season.
Right? Yeah, breakup.
Yeah. And I guess, so that's a real thing. Mm-hmm. That's a real thing when they can't get the rigs and frac crews in because there's so much slush because all the snow's melting. Not a problem they've dealt with in the Permian before.
Yeah, it's the slush, but it's also the top foot of soil freezes. And then when it thaws, it's just a mud bath. And you can push through. You call it matting. You basically put a bunch of wood on the ground and these big mats, but it's expensive. And so there are some ops that go full year. We've got roughly 6 rigs running in BC that we can full year. It's a bit of a timing game though. You definitely want to make sure that you're putting everything on pad ahead of breakup, and then after breakup, you're able to, move product. So it's a dance. We actually, breakup can be a pain, but it also can be a blessing. So this year is a weird year in Canada. The plant's on. It should be a very tight year, but this winter was a winter of have-nots. The east got quite cold. Even the spring has been, continually cold. But definitely a good cold winter for gas fire generation and rescom and everything you want on the demand side out east this year. And when we stare to the weather map all winter, we would see this nice big blob in the east where we sell some gas, and we definitely made great returns on that marketing. But that blue blob was mirrored by a big red blob in the west. And it showed in our ski resorts, our snowpack was low, and we didn't have as much rescom, and we had hydro running high in some of the markets we sell gas to. And we saw the writing on the wall come January, like, okay, this is going to be a sloppy spring. And it's turned out that way. Big west markets, PG&E, Malin, soft gas markets, because they didn't really burn as much gas as they would normally expect to in the winter. Usually you inject in the spring, and there's not that much room to inject. They got to wait till summer where it gets hot enough. They actually burn gas for cooling, and then we're kind of reset. And at the same time, the whole hydro market kind of pulled forward. We had a pretty good precipitative hydro market early, which is just now actually starting to tail off. We've gone, Pac Northwest hydro, I think, went from like 10 to 7 gigawatts over the last, call it 4 weeks. And we're starting to see that firm up in price. But breakup for a company at Tourmaline allows us to reset. Okay, so naturally we have a seasonality where we can take rigs down, allow our activity to lull. And we're not going to be in a rush this year to come back. We took capital out of the budget, $175 million cut. We announced that with the fourth quarter. First quarter, we showed that capital in the first half of the year is definitely lagging what you would expect given the full year budget on how the proration would be. So we're clearly coming in slow. And we have $200 million tagged we could cut if we needed to. And we're going to be slow to come back this summer, and we're going to watch these markets firm. And the weather needs to play a role. Heat this time in Texas and in the Pac Northwest and California, heat will play a role. And also the balancing of how these storage markets interact. But breakup has afforded us this natural pause. And I think when I think back to how I was analyzing U.S. energy businesses in the United States, where you're trying to run steady cadence, things would typically start falling off the track at Q3. The production and capital would look okay Q1, Q2, and then something would be going wrong, whether it be something internal to the business would be going wrong, or commodities weren't quite doing what they needed. And the big quarter, the quarter where everything changed, would be Q3. There are sometimes adjustments in Canadian businesses in Q3, but because you have so much flexibility in the second quarter, you get a chance to pre-communicate a reset.
Yeah, that's interesting. A moment ago, we were talking about, and you kind of brought it up in your most recent response, right? What you're describing sounds like a very disciplined and logical strategy, right? And that has not always been the case in oil and gas. And for a long time, we've been chasing the producer discipline, which Wall Street likes a lot better, because we're trying to avoid the boom bust commodity cycle that has pervaded all of history. And you asked me about this, or you sent some ideas for things we could talk about before we did the recording, and among them was the producer discipline one. So I started looking into the details of it, and I mean, tell me I'm wrong. It looks like there actually is evidence of producer discipline this time, right? Do you think, we look at the price of oil, we look at the rigs, there's clearly a correlation, right? The price is leading the rigs because they're always chasing it. When the barrels get more expensive, right? Not only does it unlock break evens, but I mean, it's more profitable for everything they have, and they want to produce, and that's how we get the cycle, and it repeats all over again. Do you think that this time, is it real producer discipline, or is it more just a function of producers don't believe that oil is going to stay this high because they know the Strait of Hormuz is going to open back up at some point?
It's a bit of both, but actually I think discipline is in full force. And your SynMax, the agentic AI answer on that was bang on, where you were
another shout out, thank you,
flagging, and
I got one left.
and I would say Conoco talked a little bit about some activity increase. And Diamondback, it was actually, K's was, I thought, quite thoughtful with how they presented their activity change. They had a great position with drilled to complete wells where they could be short cycle and bring in some volume that actually would be benefited by the higher oil prices we're getting this summer. Usually you don't have the opportunity to activate capital and get production anywhere near that activation. It's usually a 9-12 month lag, but the DUCs were there. And so that's going to be back end weighted production, which is going to serve great profits for Diamondback. And the proof in the pudding is, if I press this capital button, does my free cash flow this year go down or up? And if prices are accommodative enough and their cycle times are short enough that actually capital pays itself off within a year as free cash goes up. And we were getting that in the Ukraine crisis when gas prices were at 6. The models and development models and sensitivities were telling us, okay, prices are so high, the more we spend, the more we make. You are paying every project off inside of a 12-month period, which is also exactly a classic time of like, we know we're going to oversupply. We're not the only one who's seeing this number. But to your point, everyone else was steadfast. Exxon basically said, we're already going fast. We have no need to go faster. Chevron said, we want to wait and see this out. And as you go down the list, the independents and midcaps were looking at, we want to see how this resolves. And I think everyone anticipates this specific crisis to invoke a twist. And we haven't really seen that yet. And what I mean by that is we want to see the backs come up. We want to see 27 strips come up firm, because the hole that we've dug ourselves with this crisis has resulted in a myriad of different actions by all sorts of actors. SPR draws. China has done far less imports than they would normally do at this time of year, and they're relying on their own storage, and product inventories are coming down. So there's been a huge reaction. In fact, the reaction was so big, we've had softening in physical markets just recently where crude has come in, the financial physical spread has collapsed to a point where they're both trading closely to each other. $100 feels more normal now. We've kind of become desensitized to it. It's out of the news cycle. We don't talk about crude as a first story every day. And this is a balance that's tenuous and won't last. And these inventories that we've drawn down, these SPRs we've drawn down, all need to be refilled. And that should bring the backs up. And I think when the backs come up and operators see, okay, capital I put in today that starts a well 9-12 months from now, that well is going to have a great return. I can hedge it. That's when you'll see an activity change. But this also has an impact on your inventory life. Okay, if I'm going to go from a 10 rig program to 13, well, that means my 10-year inventory life is now 8, 7. And is that, how do I deal with that in this environment when people are really laser focused on who has what, and it's hard to count inventory. That's actually one of the harder data problems for investors, is to thoroughly vet who has great resource and who doesn't. And valuation mispricings can exist. And so if you're going to accelerate a problem that maybe isn't fully apparent, it's going to become apparent. And how do you deal with that? And so the third chapter of all this is, where does M&A fit in? And what we know for sure is in the second and third quarter, really all year, this year, there are going to be some businesses that have money they have no idea what to do with. Their stocks are up 40, 50, 60% for some of these oil businesses. Does that feel like a great time to buy back stock? It feels like a tough capital allocation decision to buy back stock when your stock is so high relative to what it would be if crude was 70, which we will probably navigate to again. You could do a large special dividend, but is a special dividend appropriate if you don't have enough resource, right? Yeah. And so this could be a bonanza of acquisitions, JVs, exploration. Yeah. Like why are we not doing that? Tourmaline has an exploration team. Colin Frostad leads it. Mike's heavily involved. We stare across the landscape. EOG is a named exploration effort. Very few other firms do. And we probably need to reignite that cycle again too.
It sounds like one of the more exciting parts of the business, honestly. If I had an oil and gas company, I think I'd want to go out and explore, find new prospects, even if they never turned into anything. But how are you thinking about, talking about the Strait of Hormuz crisis? And I also want to ask you about DUCs in a minute. How are you thinking about, you talk about the SPR being drawn down and inventories being drawn down, and this is going to push up the backs of oil. But is it also possible we can get some disruption to the front, right? You talk about that fuse. Let's say the Strait stays closed for another month, 6 months, a year, right? God only knows, right? How long?
Yes.
America's made this mistake many times, thinking a crisis is going to be in and out, right? This is going to be an in and out war, and it goes on much longer than anybody anticipates. And then also, I think people aren't thinking about, okay, when the Strait's open, it's not just going to go 100% traffic, right? There's going to be a ramp up period, and that ramp up period could last weeks or months, right? So, are there other factors in the market that could potentially cause disruption to the front futures contract? Because we've start to hit tank bottoms or the SPR's out of oil or whatever have you.
Yeah, the organized effort of rebalancing of let's put the SPRs on and China taking advantage of the oil it's stored and playing a massive role in this. I think if we have anyone to thank the most, it should be China for keeping crude prices to where they are. That organized effort has a limited time frame, and I think it varies by solution. I think on the product side, Europe is probably going to hit walls first, where all of a sudden jet fuel is not readily available and there's going to be mass cancellations of flights, and it maybe trickles into all sorts of parts of the supply chain. The demand destruction lever is the messiest, and it will be the most bombastic, where you'll have massive changes in price day to day. The disruptions and demand destructions won't be orderly. And that clunkiness can create a ton of price volatility. And I think we could go through an incredibly dramatic period in the front. And I think, obviously, if you're at $200 oil and it's back to front page news, the calculus on the Iran war also changes for everybody. And the impetus to open the Strait at almost any cost, at least temporarily, would be high. And so you would see tanker flows. But to your point, that would only impact the mid part of the curve. The first 3 months bullets are kind of last month's news, right? The physical barrels have already been not sailed weeks behind us. And it could be a massive market event that impacts people's lives in a negative way. The area we study closest is on the international side, is LNG. And I think the LNG curve right now is telling an incredibly fascinating story. TTF and JKM pricing mid-teens, high teens, depending on the day. But both curves are in backwardation to winter, which, if you stare at gas for a living, is incredibly rare. Winter should price over summer because you want to store gas in the summer and sell it in the winter. And commercial actors need to be compensated for storing gas. So they want to see, prices higher in the winter. So when they inject, they can sell forward and they lock in that spread. They cover their costs. They run their business. Many of these commercial actors are utilities where they systematically inject and withdraw on these spreads. And so to see backwardation in the strip, so summer over winter for 26, tells you that the LNG market is basically betting that this whole thing resolves and we have Qatar moving, not the 12, because we know 3's off, but 9, LNG full bore, and enough switching in Asia that we're going to be fine in the winter. But there will come a day here where we'll get to like September and all of a sudden
there's not enough time left.
And when there's not enough time, we know what that story is. We just lived it 5 years ago. Ukraine was $70 LNG pricing, right? And we know how that plays out, and we know how fast it skyrockets, and we also know some of the structure of European policy that creates demand at any cost effectively, and there's a windfall tax on the other side. And so we could have an incredible run in LNG prices that just happens. Effectively, 6, 8, 9 weeks, we could just click into this, we're short. We've got a problem. And one of the early tipping points, aside from the Strait, will be how long can Asia not consume gas? Because they've been a huge part of how the spring has remained, docile, is switching. And then one of the cool feedback loops, and this is something that I think is hard to totally see crystal clear. Coal flows are tricky, and most of the data in coal is lagged. But okay, if they're not burning gas, are they burning diesel? No, oil's high. Like, what are they burning? They're burning coal. We should have a tightening coal market. We should be hauling coal out of North America. And it's kind of the inverted way of how North America gas prices got tight last crisis. They got tight last crisis because we interrupted LNG and coal at the same time. Russia's a coal exporter as well. This time we haven't really interrupted coal supply, but we likely have had a huge shift in coal demand. And that's a slower spool, but we could all of a sudden have the coal ledge in North America step from, call it 350 today, 455, 550. And all of a sudden you're seeing power burns you weren't expecting because no one wants to burn coal when it's that big of an arb, and you chase yourself up that way. Right into a winter when LNG prices could be skyrocketing to 70. Like, it could be just this crescendo.
It's a pretty terrifying thought experiment here. I mean, you talked about kind of the dominoes that have to fall, right? There's compensating mechanisms that are happening mostly in Asia. It sounds like there's enough switching and the market's saying, the Strait will probably be open by then. I mean, what do you think traders are looking for in terms of like a date about when they expect, like, if the Strait isn't open by X, then I think we're in real trouble because there's no switching left? Or is there just not enough visibility into this kind of stuff that everybody's got a different opinion?
It's a great question. So, like, putting your trading hat right now on, these guys must be aging, weeks and days and months and weeks. The VAR limits are clearly way in, right? Yeah. The volatility is so high, everyone's book is just compressed. And the jawboning can get overnight on Twitter, et cetera, that can take a price, down 5-10% is terrifying from a risk management perspective. So, part of it is like you're looking at your fundamentals, but you're also looking at the sentiment of the market at the same time, because everyone understands the train wreck that's coming. This is one-way risk, and it should be right-way risk. Like, there's very few ways to lose over the next 3 months, because the next 3 months are cooked. You understand how the flows will work, even if it's open tomorrow. 6 months, you got a bit of change. But in general, you understand, okay, I've got a bullish bet higher with very few left tail events that can take me meaningfully lower, but I have this incredible volatility and sentiment that's driving my financial numbers on a day-to-day basis. So how do I actually express this? Like, what's my trade here? I think on the fundamental side, there, aside from straight open or not, is going to be a ton of focus on how flows are changed. So we had a huge precipitous drop on Asian imports, and we've had a huge precipitous run up on US exports. When does that start breaking things? And when do we see Chinese economic numbers start to have the impact of less consumption? And what comes out of the Trump-Xi summit, and what are their plans? That's a very important catalyst to get a sense on what's Xi's timeline here and how long he's willing to, basically idle his whole country. I don't have a calendar date. I don't have a specific flag. It'll be the flows and how flows break things. Yeah.
You'll kind of know when it's happening, obviously. And maybe nobody has a hard date.
For gas, like for domestic gas, the thing I'm looking at the most is thermal market share. So we had a great April. May was fine. But my expectation is that gas does better than people expect on thermal burn this year. And that should precipitate higher if coal prices do get going. That the data centers will really amplify that in the years ahead. And then on the LNG side, when do you start popping winter over summer? Like, as a price signal, when does the market start flinching? Like, okay, I got to at least get some contango in my season. And once that contango starts going, I think the game is up and we're on our run.
Oh, that's fascinating. Makes me wish I was a trader too. So maybe I'll be a oil and gas explorer and then a trader after that.
We'd both look much older.
I promised I was going to talk about DUCs, but actually you brought up something I think it's a lot more interesting and kind of in line with this, right? How are you also thinking about data center demand? So we're talking about draws on the energy infrastructure of the world. This is a big one, and maybe it's a little bit further dated than the Strait of Hormuz, but I mean, the amount of data center build out, even when you look at the God's Truth SynMax numbers, which have, a little more realism in them about what's going to get built when, there's not enough electrons to meet these things, right? Like, are we structurally going to see a move to, you called it behind the fence, we call it behind the meter gas, right? Kind of on-site generation, and is that going to last in perpetuity, or are we going to have to see, maybe a longer-term trend towards greater power generation?
I think at first, behind the fence has to take its center stage right now. Like when we think about how this thing is waved out, first wave is let's build up in PJM. This is where we've always done big data centers. Let's do more here. PJM prices spike and the auction goes wild and it's immediately politically contentious. Okay, where else has power? Well, we have some idle nuclear plants. So, Dwayne Reed in 3 Mile Island, let's get those unmothballed. Let's look at any asset that's not optimized on grid that we can, attach into. ERCOT, great place to build quickly. States start getting wise, Arizona, Nevada, Utah, all trying to incentivize this industrial build as they should. But it has to be just and fair, and it's not fair to have a multi-billion-dollar data center impact the power price of someone who lives next to it who doesn't have the wherewithal to have a 2x in their power consumption. And that makes sense. And politically, I think that line will be drawn very clearly and already has. And it'll be drawn similarly in Canada. And so behind the fence makes sense because you should be actually a net contributor. So if you're building your own power generation beside your data center, you're probably going to run with some redundancy. And it actually is a little cumbersome to run a power plant at 80%. So you probably want to push some of that redundancy on grid and be a contributor 99 days out of 100. And then maybe the grid can be a part of your 1 day of need. You'll probably have redundant power assets as well on site. But the way we see this moving is we see it moving into the Midwest and into the Rockies and into areas where there's land and available resource and where you can action and permit land quickly. And actually, I think Canada has an interesting advantage on the latter. Crown land isn't really a concept in America. Land is owned by the people. For vast swaths of land in Canada, it's owned by the Crown. And you're dealing with one entity, and that entity in Alberta wants to build data centers. That can move quickly. Not only can it move quickly for siting the land for the center, but it also can move quickly for things like sequestration permits, water permits, infrastructure permits, things that move across the land. The push we think we'll see at first is you're going to have to step this up. So grid power is kind of spoken for. There's a couple projects in Alberta that are going to be likely FID'd in the next 6 months that will take the available grid power. So Greenlight will be the first one, we think. And then the Keep Hills project that TransAlta is advancing will be the second. Then after that, it'll be behind fence. And that next phase is, well, how do you do behind fence? And it's been fascinating to see the power market evolve. The big power builders were burned 20 years ago, and they remember. And so very few of them have been willing to advance capital into building new factory fleets to build more, expand their capacity. And so who stepped in is like the aeroderivatives reciprocal market is just on fire, like $1 billion into VoltaGrid this week. Every week, I feel like the mom and pop frac business is also generation business. All these businesses are now, hey, we can do on-site power. How many, if we just stack these 10 megawatt generators together, we got 100 and away you go. And that feels like it's going to be a really important fit in the gap. So if you're looking for first power and I want first power by 27, your first big push will be smaller generators that are mobile, come in, consume a ton of gas actually. So they're about half as efficient as those large power plants. So from a gas consumption perspective, it's going to be bananas for 3 years because you're going to come pouring into less efficient assets that are just trying to do first power for these data centers so they can get going.
Yeah.
And then you're building the larger power plant in the background. That's ready by 28, 29. But your gas consumption is J-curved. It's nothing to a lot. And then getting more efficient as the bigger facilities are built. So the whiplash we'll have as an industry by 2029 should be wild. And data-wise, it might be hard to see. Like power plants on grid plug into the EI report really well. The industrial site that's doing everything behind its own fence, the reporting needs it has into EIA data capture, et cetera, are very, very different. And if you've poured through EIA data a lot, you'll notice industrials always seems like a bit of a plug. It's never a number that seems to move much, and it always seems to be revised later. And so this could kind of hit us as a wall. We could just feel short. And I think that'll be part of the picture in 2029 is we'll feel short of gas, and we won't quite see the consumption yet. It'll be backfilled later. The last thing I'll say is like Tourmaline thinks we have a role to play here. So we're trying to co-locate a data center next to one of our gas plants, and we put a year into it now. We've done a lot of the technical studies, engineers on staff. We have a power partner JV, we have a fiber partner. We're in market today, and it feels like this is something that it'll happen all at once. The request we've had from customers that have come to us lately is, we think we can have first power 2027. And they say Q4 27 and say, okay, I want you to spin that around and give me a Gantt chart of when I say yes, how many weeks after I say yes is first power? Because I'm trying to benchmark you against every other site that is available with your attributes. And I think we're winning on many, frankly. But this is a real horse race, which means that as these things get snapped up, it's go. As soon as you green lit from your customer and you're in, okay, spend money, secure. Aeroderivatives in, land permits done, water's going. And so the capital intensity over the next 2 years as these things actually site and get going, I think will be like voracious. It'll be a huge capitalization event for the industry, for the financing industry around it, and then tech coming into industry. And it might be one of these things where like, I've wondered if we would see utilities buying upstream businesses. And in a similar vein, I wonder if one day we see a tech business buy an energy business and just like, let's integrate this in and make it seamless.
That's a really interesting idea. It just strikes me as it is such a departure from where we were geopolitically like 4 or 5 years ago, right? When, we were all devils for using plastic straws. And it seems like there has been almost a political ground shift, or maybe it's aberrant, I don't know, right? Where, you have a Liberal Prime Minister in Canada, and it seems Canada is still going full bore into energy independence and energy dominance. How do you think about the geopolitics of the situation, right? Is there risk of, the geopolitics becoming unfriendly to energy again? I suppose the answer is yes. It's always above non-zero. But it seems like this time it may really be different, right? That there really is this kind of cohesive movement. Maybe it's about, capturing Canada's identity as a dominant energy exporter in the world. And being a completely self-reliant and value-contributing country, which, of course, Canada always has. I'm sorry, I'm not saying anything bad about Canada. But, that geopolitical risk seems like it can swing so quickly. I mean, I have whiplash still from COVID, how quickly the politics were flipping one way to the other. Do you see that as a long-term risk, or do you think that maybe it's different and Canada is dedicated towards this mission of becoming an energy superpower?
I think there's been tectonic moves, and I'm not going to say that we're on a new trajectory that'll never stray, but there's big shifts now, and they come in a couple different flavors, some of which I fully agree with, some of which I think are flavors of today. So Carney's Davos speech made big waves in Canada, and I think internationally to somewhat it made some waves, whereas concept of the middle powers need to help each other. Well, backing up from how does Canada help? And in a way, that whole speech was Canada needs to help Europe. Canada needs to be a better friend to Europe. And Germany came to Canada in the Ukraine crisis and said, please sell us gas. And we said, no business case. And Germany's come again and said, please sell us gas. And now we have to say, well, next time. And I think we have to mean it to say next time. And so Canada geopolitically is thinking, okay, what do we offer? We're not going to be the world's best military. That's never going to be our strength. But we could be a resource provider, energy security. Your backstop for supply for your economy can be us. And we can align this way to both Europe and Asia. And that's probably the first big push. And once those wheels are in motion, which they're starting now, right? We've had real policy changes, real actual infrastructure investments take place. They're not the same pace we're seeing in the United States. And I think we would all wish we could compress like Americans are able to compress the veracity or how quickly things have accelerated in the US is amazing. And we should try to take a lesson from that. But still, we've gone from totally frozen to things are moving. And we will see new export pipelines, new LNG plants. And as those wheels move, I think you're in motion. There will be a Canadian flavor to it. There will be more acuity to the emission profile of the barrel, the emission profile of the molecule. Tourmaline's now got all of its BC gas certified by MIQ full cycle as low emission. And this is something that pre-crisis, Europe was saying, we need to have certified LNG. The LNG we consume, we want to have an emission profile on every molecule so we know how emissive its chain of delivery was. And so we can be sponsoring production that we think is done in best stewardship for the globe. And I think Canada will still pursue energy development that way. And that may add a layer of cost from time to time, and it may add a little bit of time from time to time. But I think that's the way we stop being binary from we're on, oh, we're off. We're on. If we're trying to do it with a bit of thoughtfulness on development with an eye to low emission profile and an eye to stakeholder development and making sure, the Indigenous are on board with the development in areas, et cetera. That's an area where I think each political party can stand on that and say, okay, this is a platform I can stand on too. It was built by my predecessor, but I can stand on this one too. Where I want to see us get to as a nation is I want to create the energy dominance fortress North America thought for Canada and the United States. I think there's places where we don't have to agree on each industry platform, and we don't have to agree on every ideological item between the two nations, but there's such an amazing opportunity to let Canada power the AI development in America and the economic boom that low-cost energy will have for the U.S. economy, which is more than 10 times the size of Canada's, probably 15, 20 times. We would have our role. Our role is your next 100 years of energy. We can do that on oil and gas. And your role is let's upgrade the value of that energy into all the economic development and spill that back. And so that conversation's kind of been on pause. I think, KXL was something that was on the table in the first Trump presidency and has reemerged under three different pipeline names. You have Bridger and Prairie, and it's kind of KXL by a different name a little bit. And it's something that I feel politically in Canada, it's almost embarrassing that we're going to have egress to the United States and we're having more egress. We don't need to be embarrassed. Like, this is our best trading partner. It's a way cheaper way to move energy. Don't go through the Rocky Mountains. Bring it into an area where it's going to be consumed and exported readily.
Yeah. And don't put it on a train either.
Exactly. And the same exists for gas.
When you're talking about this, it's, before the podcast, we were talking a little bit about kind of like the Canadian emerging identity, and you brought it up a little bit here. You said like the Canadian flavor to it. And you also talked about, again, before the podcast, the intersection of like Canada deciding, okay, do we want to be more like America? Do we want to be more like the Europe, right? Or do we want to be something completely different, right? Going the other direction, do you think that Europe might become more like Canada? And this is obviously on nobody's radar, and it doesn't deserve to be, because I don't think there's any movement on this topic. But, like we've known for a long time, there are abundant shale resources in Europe, right? And everybody writes it off because we're like, they are never going to frack those, right? Like, no way. The last place in the world, that shale is the safest rock on earth. It's never going to be touched. But, things can change, right? Especially if Canada is kind of maybe leading the way in what is traditionally more of a liberal country, right? Liberal Western country, saying this is the way we are going to become energy dominant and energy independent. Could you see that spilling over into Europe, or is this just a pipe dream?
I think definitely. Actually, just today, Norway announced they're going to reactivate 3 fields they've obviously been the more oil and gas, petroleum heavy Euro nation, but they can lead the charge there. There's a province in Nova Scotia. It was an area, Nova Scotia, Newfoundland, Great Banks, like we had offshore development that we would be very proud of as a nation. 10, 15 years ago, Hibernia, Deepanuke, all those assets. And some of them fell off the cost curve, but in general, it was also shut down on ideology. And Tim Houston, or Minister Houston, I should say, is the premier of the province, but also the energy minister. And he just did a massive cross-Canada canvassing for, we're open for business again. Come drill a well here, come try. No one has even been exploring in that area for a long time. Mike's got plots and geologic docks on basins we don't even have a single acre in. And some of them are in Canada, areas of Canada that it is incredibly unpopular to think about fracking a well. And that's almost a swear word. But I think that can change. And I think it changes when it changes the dinner table conversation. Ontario and Quebec is an area where a lot of Canadians live and a lot of voters are, and it is definitely an epicenter of the political conversation in Canada. And they have plentiful hydro, but there's not a new dam in the forecast. There's a bit of a nuke expansion, but much of their energy growth over the next 10, 15 years is going to be gas. And they today get a lot of cheap gas out of Appalachia. Well, that's going to change. Full stop. Appalachia is turning inward. They're consuming at home. There's expansion into other data center areas and other consumption areas in the United States. Cheap gas from Marcellus is not a long-term solution for Ontario and Quebec. And so it's either going to be gas over the TC mainline from Western Canada, which we'd fully support, but also they have resources. The Utica doesn't stop at the border. The Marcellus doesn't stop at the border. These plays continue on. And I think when it changes your ability to put food on the table and your ability to live at the cost of living that you're accustomed to, that's a hearts and minds change. The area where I think the Canada-Euro conversation can get really interesting as well is Hudson Bay. There's a view that a port in Hudson Bay can make a lot of sense. And the more you look at it, the less silly it seems. At first, it's like, okay. But it's the closest path to Europe. Russia has LNG plants that break ice all the time. Yeah. You wouldn't have to break ice 12 months a year. It'd be a winter effort, and it's mostly iceberg protection. It's actually less about full sheet and more about mitigating on bergs. So it slows down a little bit in the winter. But if you had a port in Hud Bay for gas, for potash, for grain, that is an 8-day straight shot to United Kingdom and mainland Europe. And in periods like now, it's been fun to see the tankers change to the Strait of Hormuz crisis, all the reorientation, the surge into the Gulf. You bet your butt there'd be a surge into the Hud Bay, right? Hud Bay would be, okay, can't get it out of Qatar. We're coming up out of Canada. Hud Bay is full bore into Europe. That's something that we could offer the next time they ask. And I think Canada has to orient itself now, get going, start building, so that the next time Europe asks for help, we actually have something.
Yeah,
for help.
It's interesting you bring up Hudson Bay. I never thought about that. The giant spot on the map, right? Geographically, Canada's super blessed in that sense, right? That you can build it on the West Coast and you can also send it east. What about Great Lakes? You think that makes more sense?
Great Lakes, Saguenay also makes sense. The issue we would have a little bit on coming out of the St. Lawrence is just the toll stacking. And that's a short-term issue. Toll stacking it's a small mind problem because it basically means that you're only considering the gas that flows today. And so you're marching the tolls as you go from the basin of, okay, I take gas out of BC and I walk all the way along and these are all the markets I hit. And by the time I get to Eastern Canada, St. Lawrence Seaway, I'm at $2.50 toll or $3 toll. That's impossible. But what and you can reframe is, hey, if we know scale blends cost, if we could have a complex where we had a start and a 2B project could become a 4B project, everything blends down. And that's what the Gulf is enjoying today, right? And it enjoyed it, ironically, first by becoming an import coast, going to an export coast, spinning around LNG plants. Sabine is the best American LNG plant from a cost perspective, bar none. And now you're building upon successive phases and you have that scale advantage and you have that blend down advantage. We're just starting in our own coast, West Coast, of getting that blend out advantage. The CGL expansion for LNG Canada Phase 2, the pipe's already there. It's just compression. The plant already has pilings in. It's just an add-on. That makes that whole plan and project more cost effective. If you dream big in the East, it works too, but we have to concentrate our efforts and be big in meaningful jurisdictions to help and provide. To do a scattershot approach and have one plant here, one plant there, et cetera, you never get the blend down benefit. And to compete, you need it. Yeah,
you lose the economies of scale. I also like the grit aspect of being like, we're not going to pay the tolls. We're going to braid the bergs. We're going to go through the ice. Screw your tolls. You get points in my book for that. That's not worth much.
That's good Canadian branding, yeah.
Yeah. Like, what are you talking about? We're the people who brave the winter more than anyone. Not going to pay your toll. All right. I promised I was going to come back to DUCs. So I think we can finish on DUCs. This whole conversation, right? First of all, I think it really paints the picture about what energy transition really is. And this goes back to the politics of 5 years ago when energy transition was, we are moving off of hydrocarbons and we're moving on to renewable sources. And I don't think I hear anyone who's credible talking about that anymore. I think what energy transition has become, it's really convenient because the term still works, right? It's a transition to a more complex energy grid. And that creates challenges, right? But it also creates these great balancing mechanisms like you were talking about, right? Okay, there's switching that can happen in Asia. There's all these, different kind of compensating factors that can come about to keep a nice stable price, which is what everybody wants, right? Producers want it because they want to be able to have predictable returns, and consumers want it because they want to be able to make predictive investments and have predictable costs. But getting back to DUCs, DUCs are another one of these stability mechanisms that we've seen historically, right? In the Permian, we've seen DUCs. In the Haynesville, we've seen DUCs, right? And they're this great, kind of potential productive capacity that producers can kind of build up this inventory and then draw it down, right? During the bust, and you can get maybe a little more stable commodity cycle. But it's still a slow moving lever, and it's one that only moves through frac capacity, right? You still have to bring on the frac crews at the time when everybody else is likely, for the same incentive reason, going to want to bring on the frac crews. And something that we are increasingly seeing at SynMax, there's the third time, is these details, right? And it really became, details have been around forever. Like, you can go back through, the state records in the Northeast, and you can go back through the Haynesville, and you can see producers have used this mechanism as a way to create virtual storage, right? Because we haven't built out storage capacity in the last 20 years in the U.S. They create virtual storage when the contango curve gets steep enough. They're like, great, I'm going to take my wells. I'm not going to till them, which is turn in line, which really means they're not going to flow back the water, right, that they put in the frac job. And we're going to wait until prices are better, and then we're going to flow them back. Do you think that could be a potential material mechanism? Like, I think 2024, winter of 24, 25, we saw definitely an impact from detailing on markets, brought in many BCF a day of gas, right? Especially in the Northeast from all the detailing going up there. But could this, and then it 25, 26, it was just boring. There was no detailing at all because the contango curve wasn't the same. Do you think there's a long-term sustainable future, and could that be one of these compensating factors for, lack of storage build out?
I think so. I think the firm, I would say, spoke most vocally about this in the last cycle that you mentioned would be Expand.
Yep.
Legacy Chesapeake. And they were very upfront with investors. They were saying, I want to spend some money today to drill, complete, and get the well in line, but not flow. And then I have a specific hurdle at which I want this well to participate. And I'm going to misremember the number, but call it 350 or better. And their argument was the time value of money cost between waiting and not waiting is insignificant relative
compared to the contango curve,
massive contango.
Yeah.
And they were right, and it worked.
Yeah.
And I think investors liked it because we've grown supply, we've grown demand, 2 to 3 Bs a day a year for many, many years in a row now, sometimes 4 or 5 in years prior. We've barely grown storage. So the system is actually getting more fragile, more prices doing more work. The modern analog for it is going to be really interesting to watch. If I think about two things on the supply side, there's lots of things on the demand side I'm watching, but two things on the supply side I'm watching is the pipes coming out of the Permian over the next 12 months, where they hit, how they fill, how quickly they fill. Like Permian's usually doing 2.5 Bs of growth year over year. That's slimmed. Part of that is constraint. We're going to get a big debottlenecking effect. How much could the Permian really contribute over the next 2 or 3 years? But the other one is Apex. So Apex, operator in the Haynesville, owned by an alma mater. So I worked at Citadel for a couple of years before they had a big physical gas business. And after I worked at Castleton, which did have a big physical gas business. So it's interesting to see Citadel now have a big physical gas business. Citadel has backed this private operator in the Haynesville that's running way more rigs than everyone else, like way more than Expand, for instance. And so on the, I'm modeling production 1.0 analysis of like rigs could equal production, you'd be freaked out right now. Like, oh my gosh, like what's going on? Why are they drilling so much? Gas has been recovering a bit here recently, but twos for the last several months, coming out of winter, and you go through shoulder, and Apex is pounding away. But I think Apex may have an incredibly sophisticated strategy for what they're going to manage with these wells. And it may be something I've not thought of or seen before. And it could definitely be the drill, complete, till, wait, and then throw it into great pricing. But what's their flow strategy? Is it intermittent? Is it on and then always on? Or is it on only at X? What's the financial strategy behind this? Are these wells hedged? Is there a, Chessie style VPP strategy where there's, partners in the production of these wells? Like, you trust any firm to be exotic, that firm will be exotic with their strategy here. And it's a massive part of how we probably try to answer spikes in the Haynesville over the next 2 years. So what's Apex doing with its production and DUCs, and how does it manage, will be a key part. But to your point, storage becoming more valuable, operators being asked to play more of a role on just-in-time production, monitoring activity, and thinking about ways to have an appreciation of inventory available. Can you look at an operator and think about how many wells they have available to flow at any one time? Or, we just went through a cold winter in the East, and we definitely saw some reflexivity by EQT, where when prices were great, they were able to flex up meaningfully, like a B a day flex. And so, okay, we've seen that once. We understand how it came. How does that give us a sense on productive capacity for the next spike? And then if you're a financial trader in the market, how do I shave my peaks that way? How do I think about cold in an area liberates production? That solves an SD problem regionally differently than maybe I'd expected before. My upside view is now shaped by that. So I might want to express a regional bet differently.
Yeah, I never thought about Apex that way. As soon as you brought that up and you're like, this is going to be really interesting, it's my number 2 thing, I'm like, oh my God, I'm such a bad businessman. So we built a detail product in 2024 where, first of all, we surveyed all the wells in Haynesville with thermal drones, right? And the ones we couldn't get to with thermal drones, we sent out private investigators with thermometers, mobile thermometers, for them to see if the pipes are flowing or not. And we got this great snapshot of the state of every well in the Haynesville that had been completed within the last 9 months. So we knew exactly what the detail number was. Then we started bringing in high-resolution satellite photos, and we started watching to see when the flowback crews would show up, right? And we freaking nailed it in 24, 25. Like we would see them bring the flowback equipment on. 3 days later, we'd see it hit the pipes, right? It was beautiful. But the business decision that I made that was a mistake is we give away Expand and Apex data for free to all of our Hyperion customers. And then I'm like, why isn't anybody signing up for detail? It's because we took the 2 best operators. So yeah, well, it's maybe it's charitable on my part, but
that's not the
we
last
are watching
play.
them with high resolution. Okay, tell me the last play.
Well,
hopefully it's not the other one that I'm giving.
Well, I'm saying that, like, sure, you may have offered that out for free, but this is a skill that will be learned elsewhere.
That's what I keep telling myself.
You're going to have a chance to imprint the learnings and the analysis you've been able to do on the Haynesville. And, I would say the West Gassy Eagleford, like EOG would call it Dorado, you could extend that up into some of the other dry gas windows. Legacy SM has it. that's going to be a play that is going to need to answer the call. There's a ton of LNG being built there. And we know, like, when you look at these LNG plants that are coming on, they don't have perfect feed gas yet. They don't have it all plumbed perfectly yet. There's still some last mile items. Not every plant is as connected to the resource as it would like to be. You know, your analysis on and your ability to understand, okay, that's going to ramp from 0 to 2 BCF a day over 9 months. This is all going to change, and it's going to matter for these specific points, like the points around hub. You know, your different price point, like Waha is obviously a massive trade. It's just waiting to happen with these pipes coming on. But all the other regional gas points, I think Gulf Coast is going to get incredibly physical, and you'll have physical basis disparity that you could have a view on. And if you have edge on, that's a market to make.
It's always trying to find the constraint is the hard part, right? You know, you can monitor the basin, but then if the pipes aren't there, it doesn't matter all your basin monitoring.
Yeah.
And that's what we're always struggling with, but we're trying to keep on top of it. All right, you've been extremely generous with your time. I want to give you the last question. What haven't we talked about that you wish people were thinking more about? What's the thing that's not in the big meta conversation?
I think we've gone around the circle macro a bunch. I may have maybe just a little bit on, you know, where Tourmaline is right now, where we're going. So we're building in BC. We're going to build a 200,000 BOE a day platform. It's going to be paced appropriately. We'll face it into the market when the market can take it. And we're always looking at other opportunities to send gas outside of the WCSB. I think, you know, to call one pipe out, Northern Border could be interesting. GTN's been great for us. But we think we'll see a ton of consumption come our way on both sides of the border. But despite whatever the pacing is over the next 5 years on how we advance this platform out, I think the Montney in 2030 to 2040 is going to really shine in terms of what it has and who has it and where it is. And we'll be super proud to be 850,000 BOEs a day. That's going to be 4 Bs of gas that's available to market at a cost structure that's, we think, rock solid at $1.50 CAD, and delivering to whoever needs and can consume it. And we hope that's a big slice of America. It has been to date. Roughly half of our gas hits American markets, and some passes through and is exported off the Gulf Coast. We do 220 off the Gulf Coast today. But I think when you're looking at our business from an investment perspective, or you're looking at Canada from a geopolitical perspective, there's going to be a huge arc over the next 5 years where we show up for the first time in a real meaningful way in gas. Oil sands showed up in the last cycle. Gas gets to show up this cycle. So we're really excited for the next 5 years to show up ourselves and put our money where our mouth is and be builders, and then be a deliverer for the next decade. But thank you very much for having me.
Thanks for coming on.
We went around the horn, I feel.
Yeah, I think we touched on everything. I don't think there's a single unit of energy we did not cross. So this has been fun.
We'll do.
Thank you so much, Jamie.
Yeah, thanks.
Appreciate it.